Australian tax residency, buying costs to property taxes and capital gains. Now, its final session, we are bringing it all together. We will be focusing on advanced strategies to build and grow your Australian property portfolio through smart mortgage solutions and expert tax planning. If you are looking to expand your investments or maximize returns on your existing properties, this session is designed to give you the right tool and insights. We'll also have a live Q&A at the end, so stay tuned to get your question answered. Plus, that's a special offer for you all. We'll quick disclaimer. So all the information shared in this session will just be for educational purpose and not the financial or tax advices. So always speak with a professional for your specific situations. Now let's start with our expert. Pau Lam is an expat tax specialist, over 10 years of experience helping Aussie expat and overseas investors with Australian property tax, mortgage strategies, and portfolio growth. Over to you, Pau.
Thank you, Alice, and thank you everyone for joining us today, whether it's nighttime, evening, or morning at your section at your regions. Welcome all, and thank you for joining us today. To quickly sum up what we have. One thing before we jump onto the topic today. Let me give everyone a quick intro. If you are new to Odin, you don't know exactly what we do at Odin. So at Odin, we do two things, simply Odin Mortgage and Tax, which is around the Australian property journey for Australian expats or foreigner living overseas. So we are a mortgage broker, but handling for expats when it comes to foreign income, because the rules are quite different. So, and we also a licensed tax agent that helps people living overseas as a non-resident to handle their tax in Australia, from tax advisory, tax return preparation to tax plannings. If you're thinking of returning, going to Australia, would help with all sorts of tax advisory around in Australia. And to kick off, a quick sum up on what we have discussed on our last webinar, which is around capital gains tax. So we talk about the traps for main residents, that if you're a non-resident, you're looking to sell your former home where you have been living in the past, you want to be mindful of, because there will be a chance that you will lose the main residence exemptions and be liable on a huge, large tax bill. So talk to us if you have even the scenarios to make sure you are reducing your tax payable. And when it comes to selling the property, there will be this foreign resident capital gains withholding system in place. So you also need to be mindful of what you might need to pay to the tax office and how we can help you reduce this. And timing also is very important when it comes to selling the property, because of the 50% capital gains discount not being available to non-residents. So you want to make sure, like, at the time when you sell, how many years you can get the discount, how many years you don't, to have an idea when you sell the property, what sort of tax may be liable to you. And to jump onto today's topic, it's all around combining everything that we have discussed on the last 3 webinars into a more showcase demo. We're going to talk about, should you be considering a mortgage when it comes to buying a property? What is the benefit and potential risks, and how to build a portfolio with the smart strategies, what you need to be mindful of to help you reduce the tax payable. Eventually, you make your bucks out of your investments. We're going to do a walkthrough on how to create a long-term wealth from Australian properties. We're going to come up with example like we had last time on the CGT webinar. We come up with different scenarios, and I'm sure one of them will fit you. We're going to do similar, that we're going to run a live example to help everyone understand how does it work when it comes to building wealth through properties. Okay, so to begin with, the first thing is everyone have been asking coming to Odin, did they get a mortgage? What is the benefit of having a mortgage and potentially to pay the high interest rate to the bank, and why is people still using a mortgage when it comes to buying Australian properties? To give a quick intro, lending is still possible for expats or foreign investors who are looking to buy a property in Australia. We got some Australian banks, the big four banks, HSBC, Bankwest. There are also some non-banks in Australia who specializing in helping foreign investors because most of the Australian banks right now do not lend to foreigner when it comes to buying property and need a mortgage assistance. And there are some foreign banks, for example, in Singapore, in Hong Kong, there are some local banks who would also offer a mortgage as well. Generally speaking, you can lend up to 80% of the purchase price, 80% LVR. There are some banks or lenders who can go up to 95% if you are willing to pay the LMI, which is a lender's mortgage insurance. But most of my clients will go for 80% options. So they only need to come up with a 20% down payment plus the stamp duty. That's enough for you to complete a purchase. The rates right now for the Australian banks, we had a rate cut in February, and likely we're going to expect another one coming in May, potentially by another 0.25%. But what we are having for our clients right now is around 5.99. This is P&I variable from the Australian banks at 80% lendings. So which is, we can see the trend is coming down. The peak we had is around 6.5, 6.6. It has kind of come down by 0.5%. And hopefully we're going to see maybe 1 to 2 more for the rest of this year. Potentially might see at a rate of 5.5, 5.6 at the end of this year. And the bank can lend you up to 30 years of the mortgage, regardless of age. The bank can still lend you up to 30 years, even though you might be at age of 60, 70, as long as we can come up with a proper plan on to showcase to the bank how you would repay the mortgage. You can go with P&I, you can go with interest only, and you can also do equity release from your existing properties for further investments. The advantage of having a mortgage leverage and the rates is also important as well. Ideally, using a mortgage can help you to increase your borrowing capacity. You can buy something more expensive, and you can leverage with the bank, which eventually would give you a better yield, a better return on investments on the money that you put in. And there is also tax advantage through negative gearing from mortgage. The interest you pay on a mortgage is tax deductible on investment properties. So whatever you pay is simply deductible against the rental income, which helps you to reduce your tax payable, and you can accumulate or to accumulate a bigger losses. And also, it gives you the ability to diversify your investment portfolio. Either you're looking to buy another property in other states to diversify, reduce the risks, or you're looking to draw equity for other personal purpose, other investments. This is what you can do through a mortgage. And more importantly, this is quite a unique feature in Australia, which is the offset account. Not many countries do offer an offset account, and you might want to utilize the offset, which can help you reduce the tax payable, interest payable through the ups and downs of the interest rates. And we're gonna have a section talk about what an offset account is all about. Even though it brings you all these benefits of mortgage, but it is also important to understand what is the risk, what is your personal risk tolerance, and how does it impact your cash flow. Whether over leverage would cause a problem to yourself, you're putting yourself on high risks and cost yourself, from a cash flow perspective. So these are all important risks that you should weigh before you go with a plan. And also, it's important to understand what the interest rate market might be. We could have a good time like we had 3-4 years ago at zero interest, the 3% interest rate, which is at zero cash rate from RBA. But you could have a hard time right now at 6%, 6.5% when the rates start to jack up. So, and also the market trend as well. There has been some ups and downs in different cities, regions in Australia. So it is also important to understand what the markets would impact you with a mortgage. And this is a very common questions that I've been asked when a client comes to me about buying a property. They always have the question, I have the money, why should I consider a mortgage? The answer is quite simple. It gives you the benefits. Imagine this, you got 1 million cash, you want to buy a property, a single property. You can always go with the cash that you have, and don't need to worry about the mortgage and other risks. But if you want to be able to accept a higher risk and want to take this a bit further, that 1 million that you have can be split into four properties, because each of them will only need a 20% deposit and 5% roughly for stamp duty. So you probably need about 250 per each property, and you can leverage a mortgage with the bank. So this can help you to diversify your investments from turning one property with cash buy to four property with a mortgage. Again, you need to understand the risks associated with higher leverage and more investment properties. It will then give you a higher return on investments, because having one property definitely cannot compare to four good potential investment return properties. And you can also take advantage of the offset account. For some cases, you're only looking to buy one property with the money that you have on hand. That can be done and that can be acceptable. What you want to do is still leverage with a mortgage while putting your money into offset account so you can enjoy the flexibility. And here is how an offset account works when it comes to having a mortgage. A quick example, let's say you have a $500,000 mortgage with a bank, and your monthly repayment is at $3,000, which is about $2,500 for the principal and $500 for the interest. If you also have that 500K now you don't pay for the purchase, you have it sitting in the offset account, it would help you to offset the interest completely. So then your repayment will remain the same at $3,000 because that's what the bank would like you to repay, to make sure that you're on par on the schedule. But the whole amount will be paying against the principal, which means there's no interest component at all. What it does is it helps you to pay off the mortgage much quicker. So this is one thing that you would like to retain the cash flexibility, just in case anything happens to your life, you need the money urgently. You can always take out the money from the offset account, or you do see an opportunity for investments that can yield a decent return. That's something you can look into to see, oh, if I take the money out, that can actually earn me a bit more. They want to take advantage of the ups and downs of the market and other investment opportunities. So what it does is when it comes on a high interest rate market, that's when you would want to put the money into offset account to reduce the interest expenses. You don't want to pay the 6%, 7% to the bank when you have that money sitting somewhere else, only earning, say, 3% of return. Potentially, you might need to pay a bit more tax because your interest expenses has been reduced. You don't have that much of expenses to offset against your rental income. But I've done the math. It can work, and it still makes sense to just pay tax instead of paying the interest. But say the market change in a couple of years, we start to have a low interest rate market. That's when you want to, why an offset would help you a lot, because you would like to have that money to reconsider what it can bring you from other investments. If you do find other investment opportunity that can earn you a more high return more than your interest rate, that's when you want to take the money out from your offset account, because one, the return from the other investment would help you to cover the interest cost, which means it costs you nothing to have the money not sitting in the offset. But what it brings you is you can claim the interest that you paid on the mortgage in your tax return, whether it can help you to reduce the tax payable or it can help you to generate a much bigger loss, which you can use it in the future. And so when it comes to building a portfolio with the strategies, I use these facts a lot when talking to clients. According to CoreLogic, the national dwelling value has increased by 380% in the last 30 years. Australian-wide, regardless of property type, whether it could be a house, townhouse, apartment, it's the average. So that equals to about 5.4% per year growth annually. Obviously, you're going to have something that increasing less than this amount because come up with a bad decision on a bad property, but you could see people make a right decision and that increase in 10, 15, 20% per year. So right property makes a huge difference when it comes to how you're going to make money from the property eventually. A few strategy I'm going to talk about. The first one is always buy and hold. If you are considering having a mortgage, then the rental yield with a mortgage, the rental is not enough to cover from the current market. They want to focus on a long-term capital growth and potentially with some stable rental yield. Because having a mortgage, the profit you're actually making is from the capital growth, not from the rental every year. Then that's why a good investment property with a huge long-term capital growth is where you're going to make your money from. It's also important to understand the location, the type of property, and the timing of the market. We are having a bad time for Melbourne, for example, right now. So you might not want to enter into Melbourne market, or you could see it the other way, which is a good entry point to enter into Melbourne market. If it starts to pick up, that's where you make your profits. We had decent yield in the last growth in the last couple of 2 years, 3 years in Brisbane, in Perth, in Adelaide. With 10, 50% growth per year, but there's always a cycle. You always have the ups and downs. So it's important for you to understand where are you buying, what are the type of property, and potentially want to utilize some buy agents for a potential better return, because if they can give you a better advice on location and the yield of the property, it might be worth for the money to pay for their fee and get something eventually can earn a decent profit for you in the long run. Another strategy you can look into is to use equity in your existing properties. With you start paying down your mortgage and property goes up in value, that's when equity has been created. You can draw equity, unlock this equity for your next property purchase or to do renovation to increase your existing property value so you can sell at a better price, or you can again draw money for other investments that you see fit that can earn you a decent return as well. And this is also to diversify your property investments into different types of property. It could be apartments, mix of house, townhouse, and mix of locations, cities, suburbs. Which can help you reduce the tax payable. And one thing I always talk about is in terms of diversifications is to reduce the land tax. That can also help you to bring down your total land tax payable if you have the right strategy in investing into different states. Third one, with the mortgage, because you can claim negative gearing, you can fully utilize the mortgage for the tax advantage. For properties. So ideally to create some decent losses for the ownership of the property. And these losses from multiple properties can be used to offset the future income. You could be selling the first one that you bought and make a decent profit. And these are the losses that you can use to minimize tax payable and still have more money on your hand for further investments. So yeah, consider mortgage and take advantage of the negative gearing is one of the important strategies. And another one that I also come across quite often, which is underperforming properties. People got stuck on a bad property for over 5 to 10 years and still did not see any potential or huge increase in value. And they've been paying huge expenses every year to run the property, to keep the property going, but eventually they're still not making any profit from the rent, from the capital growth. If you do come across to a not performing or underperforming properties, it might be a good time to make a decision and just take the loss to release the money and release equity and use it into somewhere else that can eventually help you to get a better return and hopefully to catch up on the loss of time that you waste on the bad properties that did not perform in the past. And eventually, last one that I have here is about tax deferrals. The idea of this is to have more money on hand for now. You want to defer your tax liability to future, and something to do with the dollar value, because everyone, I'm sure you can understand that $1 now is definitely worth more than $1 in 10, 20 years, because the buying power with inflation caused the problems that a buying power for now would definitely be worth more than in 10 years. So this is what mortgage and negative gearing is a type of tax deferring. With negative gearing, you are not paying any tax to the government, which means you have more money on your pocket that you can use for leverage. So as the money you borrow from the bank, that's what you can use for investments, which can earn a better return and try to push your tax liability, which likely to be the capital gains down the line in 10, 15 years. And when you sell at that stage, the losses you have accumulated, the profit that you have made from your other investments can help you cover the capital gains liability. And to counter the inflation, roughly right now around 2 to 3% in general. People usually hedge against inflation for properties, for example, equities on the market. Sometimes you can look into interest, but when the interest rate is low, the interest, a term deposit would only get you maybe 1 to 2% of interest, which is not enough to beat the inflation sometimes. So most of people will look into properties as a hedging solutions. And to come to, again, the really hand-on demo walkthrough on how Odin can help you to build a long-term property portfolio through mortgage and tax. So we're going to start with this property one, which is a Queensland. Let's look at buying a property in Queensland for $700,000. With leveraging with the bank, you only need to come up with 168,000 to complete the purchase. So the table here will show you for a $700,000 purchase, we borrow 80% from the bank, which is at $560,000 on mortgage. When we factor in the stamp duty, the government fee, legal fee, etc., that's about 28, and that's how you need to come up with $168,000. And the annual mortgage repayment on this $560,000 would be around 40K, 41K, close to. This is P&I variable. This is what the rental schedule looks like once you have completed purchase. Assume a 5% rental yield from the property, you're gonna get around 35,000 in rental, less all the expenses that you pay on the property, the council rates, water rates, the interest you pay on the mortgage, the insurance, agent fee, repairs, and depreciations. From a tax perspective, you're gonna come to a net loss of 11,500 per year. That means you don't need to pay tax to the government. You can accumulate these losses. So here's a quick summary. How much you need to come up with in terms of cash flow to maintain the property is around $15,000. So rent is around 35 minus the rental expenses minus the mortgage you pay at 41K plus, you would need to come up with $15,000 of money to support the property every year. And you can accumulate 11,500 for tax losses. This can be used for future to reduce your tax payable. On this scenario, because with a right decision, right investment, that we buy this property, first one in Queensland, at $700,000, which the land value is clearly below the threshold of 600K in Queensland, this is why we don't need to pay for land tax, so we can save on the land tax. And imagine now we got this property and you keep running for 5 years. Let's just use the average 5.4% capital growth per year. So in 5 years, your property value in this Queensland property should goes up to $910,000, which creates opportunity for you to draw equity from your property to buy the second one in South Australia, for example. So step one, we're gonna release equity from property one. So in 5 years, the property value goes up to 910. We can still lend up to 80% of the mortgage, which is $728,000. Your mortgage, we start with 560. In 5 years, you pay down about 40K. That brings down to 522 on your existing mortgage, which means the bank can still lend you another $206,000 to assist you with the next purchase. So we're gonna tap into the equity that you have, assuming you can pass the servicing with the bank is happy to lend you the amounts. We're going to use that money to buy another property in South Australia, which is at $850,000 this time. We're going to do the same. We're going to borrow 80% from the bank and use the equity that the bank offer at 206 plus the stamp duty, legal fee. You only need to come up with $14,000 to complete this purchase because most of the money will be funded by the bank. You only need to come up with a small amount of your money to complete the purchase. If you do have money, that's where you would consider putting the money into offset account to play with the flexibility and the cycles of the interest rate markets. On this, about $886,000 of mortgage, your monthly repayment would be annual repayment would be on the mortgage. P&I would be around $64,000 and 700. This is what the rental schedule will look like on these second properties. Similar 5% yield on this property, you're gonna get 42,500 in rental. Less all the expenses you have, similar to the one that you have in Queensland, the council rates, water rates, the interest on the mortgage. This is the interest on the two, which is the 886. The one that we borrowed from the bank and the equity release that we got from the first one. Minus insurance, everything that I've listed out here, you're gonna have, again, a loss on this property at around $23,000. So how much you need to come up with to maintain this second property? It's more than the first one because you are literally leveraging every dollar from the bank on this purchase. So in short, you need to come up with 30,500 every year to support the property. That includes the mortgage, includes all the property expenses. And you can accumulate the $23,000 losses to use to offset your future income. Again, we diversified this property in South Australia because they give you another $6,000-7,000 threshold on land value. And with this property, we have not meet that threshold, so we're not liable for land tax as well. Now you have got two properties in 5 years of assuming a return of 5.4% return. And it can be better, it can be less. It all depends on the property performance. With the right property, you should be able to achieve these goals. And we're going to look into the third one. Now, another 5 years, you're going to planning for your return to Australia. You're thinking of buying your dream home that you're going to live into. Could be in Sydney, could be in other states, but let's just use Sydney, for example. And this time we're going to target on more expensive properties at a 2.5 million property purchase. So what happened to your two properties right now? The first one that you have in Queensland that has been 10 years. With a 5.4% increase in value compound, that has now increased the property value to 1.18 million. And on the one that you have in Adelaide, which you bought for 5 years, it also increased to 1.1 million in value. Same logic, the bank can lend you up to 80%. We're gonna draw equity. We're gonna the first one here on the left-hand side, the 470 is the mortgage on your first Queensland property that you have paid down from 560 to 470. And the bank, after deducting that, the bank can still lend you, and this second property, second mortgage is this 192 is the one that you got, the 206 that you cashed out last time, 5 years ago, to assist with the purchase in the Adelaide property. It also come down to from 206 to 192, which means we can tap into equity for about 282. Same logic applies on the one in Adelaide. 1.1 mil, you can borrow up to 880. You have a mortgage that has been paid down to 633, and which means you can tap into equity for another 247. That gives you about 530 in total in terms of equity that you can draw into. And that's what you can use to buy the property in Queensland. So 2.5 mil property, we're gonna borrow 80% from a bank. Less the equity, the 529 from the two properties you have, plus the stamp duty. At the end of the day, you only need to come up with $96,000 as the funds that you need to bring in for the purchase. And eventually, the annual mortgage on this 2 million mortgage plus the equity release would be at 184 per year P&I in terms of repayments. What does it look like in the rental schedule? The yield may be lower, a bit lower on a house at this price point, maybe between 3.5% to 4%. Let's use 4 for now. You're gonna get 100K of income, and when you deduct all the expenses and interest, and this time you potentially will need to pay for land tax, because on the 2.5 million property, roughly the land value will be about 1.2, a bit higher, a bit lower, which means you're liable to pay for land tax this time on this property. And because we separate every investment in different states, so you're not looking at all your property for land tax, you're only looking at the one that is exceeding the threshold. So at the end of the day, you're gonna have a net rental position of $78,000 losses that you can accumulate. To support this property every year, you need to come up with 101,000 per year after deducting the property expenses, the mortgage, and you can accumulate the losses. So now this is the third one with the equity release you can do from your properties. Let's have a look on a quick summary. But this is what the projection looks like on the 3 properties. The first one you own it for 15 years for now. The second one in Adelaide you own for 10 years, and the third one you just bought it for 5 years. Okay, after 5 years, for example. This is the accumulated losses at year 15, how much you have from each property. That comes up a total close to $800,000. Now, we want to return to Australia, now looking to sell the property. You want to move into your home that you do not want to have a huge mortgage. Let's have a look on the sales of properties. How does it work in terms of the capital gains and in terms of the return on investments? So when you sell your property one, the Queensland one at year 15, this is what it looks like. The value will be around 1.54 million, and less the cost, including the original purchase price, plus the stamp duty, plus legal fee, commissions, etc. And I'll add back the depreciation that you claim on the property. And because you have been a non-resident for full time in this last 15 years, you will not enjoy any 50% discount. So at the end of the day, you're gonna make capital gains of 817. But because of these losses that you have accumulated over the last 15 years, it would now be used to offset the income. So instead of paying tax on the $817,000 of profit, now you only pay tax on 21,000 after utilizing all the losses that you have. You only pay tax for $6,000 to the tax office. The return on investments. This cash flow is what you have been paying in the last 15 years on running this property. I think we have the number at around 12,000 per year, so times 15, that's what it comes up to 226. This is your property sales price minus the tax payable, minus repayment on your mortgage. The first one that you have at year 15, you should have about 400K left if you stick to the schedule, minus the agent fee. This is how much you're gonna take back in your pocket, your after-tax receipts. And when you claw back the money that you put in, your net profit on the property will be around $868,000, which the return on investment, this is how much you bring in the first place to come to buy the property. The return on investment in 15 years is around 400 percentage. So this is one of the example when it comes to time of returning and looking to sell the property, how it can help you to reduce the tax payable on the first one that you sell with the accumulated losses. And you can have more money back in the pocket for other investments or to pay down your mortgage. So this is another 867 contribution towards your home. What if we want to sell the second property as well and want to clean up all the properties and want to take back as much as we can to pay down the new senior properties that do not want to have a mortgage? We could also look at selling the second properties, but this one will be slightly different because of the losses that we have fully utilized on the last sales of the Queensland property. So when you sell this property, which is at the ownership of year 10, it would come to about 1.4 mil property value, less the cost base, the purchase price, stamp duty, the same expenses, and clawback on depreciation and no discount. You would have a capital gains of around $525,000 because we do not have any further tax losses that we already fully utilized on the last sales of property. That's what you need to pay tax on. The rate will be around 45%. So out of the tax, the capital gains of 525, you pay around 236 in tax to tax office. To keep it simple, I have not factored in the super method that I mentioned on the last webinar on how you can use super to reduce this tax payable to a lower amount. Let's not talk about that one to make it simple to understand the logic first. And if you want to look into that, we can always come back later. So when it comes to return on investments, this is what it looks like on these athlete properties. This is how much you put in on the property. So this should be 10 years, not 15. So in 10 years, you put in 30K per year roughly. So in 10 years, you put in about 205. And your return on investment, this is the sales price minus tax payable minus the mortgage. This is the two mortgage that you have, one on the existing mortgage, one on the cash out, and minus sales cost. This is how much you're going to take back in your pocket and your profit after minusing the money they put in the property to maintain. You still have a profit of about 111. You only put in $14,000 on this purchase. So your return on investment in 10 years on this property will be around 683. The biggest, like even though coming from looking at this number, it doesn't seem to be a lot. But what this property has actually done for you is the losses that it has accumulated in over the 10 years period. And that's what you can use to offset the losses, that the capital gains you make on the first property that you sold to reduce the tax payable. And that's why you don't have much left over. You need to pay a bit of tax on this second one. Okay, so to summarize what has happened then after 15 years of hard work living overseas. You sold the two properties you have in Queensland and South Australia. This is how much you take home after you pay the tax, after you pay for agent fee, after you pay back the mortgage. The number we took from the previous slides. So that brings you about 1.5 million cash. In year 5, on you planning on returning to Australia, your Sydney property should increase in value from 2.5 to 3.2 with a 5.4% increase per year, which brings you a loan balance, and you still have a loan balance in year 5 about 1.8, which is reduced from 2 million that you had in 5 years ago. When you contribute your proceeds from sales from the two properties to reduce your balance on the mortgage, because on this property, when you are now returning and want to live into it, you do not want to pay the mortgage to the bank because you don't you cannot claim the interest anymore on that property, on that mortgage. You can either pay back the mortgage or you can again leave the money in the offset account for the flexibility. It helps you to reduce the interest payable, but at the same time, it would give you the flexibility just in case you want to use that money for other investments to buy another property, then you can always take it out and use it. But if you choose to pay off the mortgage, then it would help to bring down your remaining mortgage to $235,000, which means in 15 years, you have created equity on a place that you want to live in for 2.8 million, almost 2.9, because you only have a small mortgage at this point of time, and your property has increased in value. So this is what a good investment, right property with right strategy along the line with mortgage and tax could help you achieve for your hard time working overseas, living away, leaving the family or friends in Australia, earning on overseas income, how you can better utilize your income to reduce the tax payable. And this is the end of the presentation. And maybe we can start to look into some of the Q&As. Let's see if anyone has some questions. And to take away, a few things to remind is to leverage the mortgage wisely. If you can and you can afford it, you're okay with the risk tolerance. You might want to use a mortgage, which give you the ability to buy something more expensive with the leverage, and eventually that can help you to generate a bigger return on your capitals. And also, you don't need to use all your capitals in one bucket. You can use in something else as well for other investments. And take advantage of the negative gearings. And from the example, you can see negative gearing for those losses you accumulated can show play a big part when reducing your tax payable on potentially accumulated over multiple properties to offset the capital gains on the first one you sell. That's when you can use the money for further investments. And to diversify your investment portfolios. It's very common that I've seen from our clients that they invest into one state, eventually they get themselves a very huge land tax bill. And if anything happened to that state, for example, in Melbourne, the general market was a bit down, then all your investment get affected. So don't put your all your eggs in one bucket. Try to leverage, try to diversify across different states. Take advantage of land tax threshold. Take advantage of the market growth in different states, different cities, and also to reduce the risks. Anything happen to one state potentially may not affect your other one in other investments in other states. And to focus on long-term growth, and it's hard to make a quick buck on flipping the properties in a short term of owning a properties, unless you're really good at picking the right property that increase in value every year, 10, 15, 20% per year, then potentially you can make a quick buck in 2 to 3 years. But in general, in average, maybe expect something around 5 to 10% per year, and play with the time that you have been away from Australia, and potentially plan for your return to Australia when it comes time. Then ideally you want to have something they want to live into, and the other investment can help you to bring down your mortgage. Okay, so I'm gonna pass back to Alice. Maybe we can run some quick Q&A, live Q&A. Feel free to drop your questions in the chat right now, and let's have a look into all of those. Alice, could you help to pick some questions and let's run over it?
Sure. Thank you, Pau. So the first question is, what are the advantages of using a Singapore bank for Australian property? And are the loans in Australian dollars, or do they have currency risk?
Yeah. So it when it comes to tax, the mortgage doesn't need to be coming from Australian banks. It can be from, like I mentioned, overseas banks who also can do Australian mortgage, or it can be another equity from your existing, say, Hong Kong, Singapore, US, UK. You got a place in there, and there are equity there. You can draw money from there. The problem with the Australian banks right now is they can only offer against Australian properties and in AUD. They do not do multiple currencies. So you're kind of tied to whatever happens in Australia. But if you do see an opportunity that, say, in Singapore, you can get a mortgage at a rate of 3% using your Singapore properties, you might want to look into that because it helps you to bring down your interest expenses, as long as you can achieve the same goal to have access to that money.
Okay, thank you, Pau. So the second question is, how is capital gain tax affected by how many years as a tax non-resident? Is it a percentage of time away?
Yeah, so we have covered this question on the last webinar. I'm happy to answer again. So when it comes to capital gains tax, what we look at is the tax residencies. How many years you're living away as a non-resident because of the rule change. As a non-resident, we no longer enjoyed the 50% capital gains discount since 2012. So, for example, you own a property for 20 years, 10 years away from Australia as a non-resident, and 10 years when you're back in Australia. It's like pro rata. based on the number of years that you can enjoy the discount, which is the 10 years when you're in Australia. So it's a pro rata calculation based on the time where are you in Australia as a resident or non-resident.
Thank you. So another question is, does having a property in Australia makes you an Australian resident for tax purposes? If yes, then can the overseas income be taxed in Australia?
Yeah. So no, buying an investment property does not automatically make you a tax resident of Australia. So people can still buy investment properties. What we come to look at when it comes to tax residency still, again, cover in the first webinar that we talk about. You look at where do you live? What is your intention? Um, Unless you're buying something owner-occupied property and leave it vacant, that would at a point when ATO assess your tax residency because it might create a problem for them to see that, oh, why you buy a property but not being rented out? Is it for something for you to return and live into it? Would that create a problem? That to show the ATO can see that you might be returning Australia and become a tax resident. But when it comes to investment property, it would not make a problem as long as you've been renting out the property.
Thank you. So another question is, what if I want to sell the first property while I'm still in Hong Kong and not when I move back to Australia? Does the negative gearing amount still be used as a credit to reduce taxable income?
Yeah, so these tax losses, they are indefinite. They will not expire. They there are pretty much three common areas that you can use them. One is you pay down your mortgage, your property becomes positively geared. You start to collect positive income from properties. That's when you can use the losses to offset the rental income, positive rental income. Or when you return to Australia, start working, start to collect employment income, salary, then this is what the losses can use to offset your employment income and you can get a refund from the PAYG tax. Or the example that we use here to offset your capital gains, so you pay a less tax in the future as well. To jump on one question here I saw, someone asked about does Australian banks recognize foreign income when living abroad? W2, which is US. Yes, the Australian banks can still recognize Australian so overseas income. And this is why we have Odin Mortgage to assist you. But the rules are very different when it comes to foreign income lending. Not all the banks will do it. There are only a particular bank will do it, and they run a quite harsh, and you can put it that way, quite harsh calculation servicing different policies. Discount your income by a percentage, and then apply the tax minus your living expenses, liability to confirm how much you can borrow. So something our team can help you if you are interested to find out how much you can borrow. Our mortgage team can help you to run a calculation to see based on your personal situation, which bank can lend you a mortgage and how much would that be.
Thank you, Pau. Another question is there any benefits, disadvantage of putting the property separately in a wife or husband situation, or is it better to have them together?
Yep. So it could be, there's no direct answer or confirmed answer on this one because everyone's situation could be different. But maybe let me try to explain what might be the difference. But if the benefit of putting in joint name is you can spread the income 50-50. So which means the future capital gains as well. So potentially instead of putting for one to have the whole capital gains and be exposed to the 45% top bracket, there could be a chance that if you split the income 50-50, the income when you sell the property, the capital gains could be divided by two and you pay a lower tax on a lower bracket. So that's one of the benefit for having joint name. Having separate name could different in the way that you might want to have your main residence and your wife may want to have her main residence. So in that scenario, because everyone can claim one property to be their main residence and that property can be exempt from capital gains tax. So that could be a chance that you buy one under your name and claim as your main residence and your partner buy one under his or her name and claim the main residence as well. So that's what with proper planning and if the timeline can work, you could have two properties that potentially be exempt from capital gains tax completely.
Okay, another question is, after the April 1st changes regarding overseas investors that can only buy new properties, can Australian passport holder buy second-hand properties still?
Yeah. So on this new change, yes, sometimes the government or ATO's wording is very confusing, but the correct answer to this is this change does not affect Australian passport holder or PR. You can still buy any second-hand properties after 1st of April. This is only to target people completely a foreigner who does not hold Australian passport or PR, mainly to target people holding a temporary visa in Australia but living in Australia. Because under the past rule, the previous rule, these people living in Australia holding a TR visa can still buy second-hand properties. And this change is to stop that. You can call it a loophole to stop people from buying, even though they are living in Australia. But it does not affect anyone living overseas as long as you're Australian or PR.
Thank you. Another question is, any advantages of using offset account if you want to capitalize on negative gearing?
Yeah, so I think one of my slides has kind of mentioned this. You want to have an offset and try to leverage with the bank to have the flexibility. But whether should you put the money in the offset, it really comes back to the questions. What sort of interest rate are you paying? What can you do? Can you do better with that money sitting in the offset account? Right now, we're looking at a rate of 6.1, 6.2. If you are to take the money out from the offset, would you earn a better return more than 6.2%? If you can, I would then suggest you to, yes, move the money out from there, put into other investments that can help you to cover the costs. If not, maybe you want to just leave the money in the offset account for now and wait until we start to see some more rate drops. When the rate starts to come down, you can then reassess at that market. Can you do better with that money in the offset account? In that scenario, you might need to pay a bit of tax, which it would be worth than you paying the interest to the bank.
All right. Another question is it worth creating a trust and buy properties through it or own or in own name and wife's name?
Yeah. So comes to trust holding, there are both mortgage and tax considerations. From a mortgage perspective, not all the banks, like I mentioned, there are already limited banks who can do lending to expats when it comes to foreign income. And it is even harder when it comes to buying under a trust because not all the banks would do it. There are even less bank would do for trust lending. So you need to assess whether lending is possible under a trust structure and whether the trust actually bring you the benefits. People use trust a lot in Australia because you can distribute the income to different person, different beneficiary, and potentially pay a lower tax. But when it comes to expat, it's not that common in the way that one, you could be making a loss, there is no income to be distributed. Secondly, is all your beneficiaries are with you overseas. You don't really have someone to distribute that profit. So it doesn't really bring that much of benefit to hold a trust. Unless you're thinking long term in 10, 20 years, eventually when you go back to Australia, it might make sense.
Thank you. Well, thank you everyone for great questions during the Q&A sessions. If you didn't get your question answered today, please don't worry. A tax accountant will follow you up shortly. But now we have something exciting lined up. Pau has some special news to share with us. So over to you, Pau.
Okay, as we mentioned at the beginning, we want to do something different before we wrap up. And thank you for everyone to taking your time to stay with us until the finish of this webinar. We know you're busy and it says a lot to make it a priority to show up whenever the regions you are at. If you have come to some of our past webinars, you might know that we have been doing a free consult, which is to have a chat with me to look at your personal situations. But we're kind of running out of time and getting busy because of the financial year is coming to an end. So instead of doing offer and free consult like previously that we have done, we want to do something different, which is a $250 early bird tax return discount. If you sign up, here's a QR code. If you want to sign up with us today, we are happy to give a $250 discount to our clients. So what this tax return services gets you is you're gonna get a full year support in terms of your Australian tax. We don't charge additionally going forward once you become a client of us. If you want to talk about any ad hoc personal tax change situations, you're just one click away from making a booking with us to have a check on your personal situations. And I think the more important one is we specialize in this area. Very different to most accountants in Australia, we are more specializing in the non-resident tax. So we help with tax presidency, property investments, capital gains, tax planning, etc. And the process is quite easy in the way that it's a simple document upload system that we collect from you and help you complete the rest. You don't need to jump in and do a lot of working. We will send you the return once we have completed. And it's all personalized reviews that we do for our clients. It'll be reviewed by our senior accountant, make sure everything is done correctly to maximize your position. And if we do see opportunity to help you reduce the tax payable, we will also help you to implement the tax strategy that we have discussed in the past. And eventually to make sure you are stay compliant, make sure you can be seen as a non-resident, whatever you make overseas is not taxable, and you don't need to worry about things happening back in Australia. Will be your helper to look after you on the tax perspective. But you want to scan the QR code real quick and try to take up the slots. There are not many left. I have to say, we only have 20 slots for this offer because we are getting busy, so we don't really have. We need kind of like planning to wrap up the financial year to get back to client to prepare for another tax years to come. So if you miss, you cannot book the meeting from here, don't worry. Our team will reach out to you shortly and then send you an email with a link. You can click from there to book a meeting as well. And our team will probably, for those questions that has not been answered during the sections, our team will reach out to you to try to help you on a personal level to see if anything we can help you to mitigate the questions or issues. And again, thank you for everyone to come to the webinar tonight. And this is the final section of the webinar, which covers from tax presidency to property income tax calculation to capital gains to now how you can potentially turn your income, overseas income into wealth with a proper planning and with a long-term planning as well. If you have any questions, feel free to reach out to us. We're happy to have a chat with you and to assist you on your tax returns, and feel free to take up this offer as well. Okay. We do have for anyone who only joined us on this webinar, if you are interested to look back on the previous recording of the last 3 webinars, we also have a recording on YouTube, so you can always reach out on YouTube, Odin Mortgage, and you can find the recordings for the last 3 sections. Okay. So thank you all for staying this either early or late with us, and I look forward to see you when I come to assist with the tax returns. Okay. All right. See you. Bye.